Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, what we need to do and have needed to do is prepare for recession. Don't forget, you guys, there's terminology like cash is king and like you make a killing during recession for a reason because so many people don't care what's happening right now. But I know beyond a shadow of doubt, you guys care. And it's not just the stock market, you guys. We've had other recessions where we've had price decline. Take a look at this. Now, despite what Dave Ramsey wants you to believe, there was actually 1, 2, 3, 4, 5, 6, 7 different years where we had a national decline in home prices. We have 7 years, and that's not even counting the Great Depression. So again, what I'm trying to say is we've actually had 3 recessions where we've had negative price decline in the housing market. But today, what I want to do is really go over why we should even consider a recession. What are the factors that are telling us that a recession is coming? I mean, we've been talking about this for what? 2 years. So I think it's time we figure out what's happening in the economy. And I'm going to tell you guys right now, this economy is the most toxic, unhealthy economy in my entire life. Even more unhealthy than the GFC. Let's get started. Now, the first thing I want to point out real quick is the tentative schedule of the Treasury buyback operation. This is the first time this has happened, I believe, in 2 decades. If everything was okay in the economy and also in the bond market, then there wouldn't be a buyback program. Now, the crazy thing is this actually starts tomorrow. So it starts the 28th, you guys. And the first buyback operation is going to be on the 1 month and 2-year treasuries. So remember, when people buy those, it goes down. Those rates go down. So that's very interesting. So after that, on June 4th, they're going to do the 20-year and 30-year. And then on July 1st, that's when they're going to do the buyback program for the 10-year and the 20-year. They're also doing another 10-year on July 23rd. And that's several billions of dollars, guys. So a lot of people are saying that that's basically a bailout. That's very similar to a bank bailout. They're not supposed to be manipulating the market like this. When they do that, they continue to devalue currency. But where I want to start, you guys, is I want to start once again, and I also want to explain the yield curve inversion. This is one of the most important forecasting sets of data that spells a recession coming. Remember, you guys, the yield curve inversion is the forecast, and it's very extremely reliable. Now, obviously, when it comes to recession, there are many different factors and many different things that change that would bring on a recession. But the great thing about the yield curve inversion, it's a single set of data. And that's why we constantly look at it, because it's all of these crazy things, but we have a single set of data to review that warns us and forecasts a recession. And make no mistake, the yield curve inversion right now is forecasting a recession. And in fact, if we don't have one, this will be the first time in history that we've had so many of these factors hit us that we didn't go into recession. Now, I don't know about you guys, but I'm getting sick and tired of all the data manipulation and all of the lies in mainstream media. And quite frankly, I'm pretty convinced that we have a high probability of some type of crisis coming right around the corner. When is it going to come? I don't know, probably after election. Let me know what you think. Let's jump into the yield curve. This is the 10-year maturity compared to the 2-year. Now, remember, the 10-year is a longer term, and therefore it should have a higher interest rate. But right now, that has reversed. And right now, you guys, we actually are more inverted than we have been in a while. We're 47 basis points inverted. Now, we first inverted right here, April 1st of 2022. So shortly, like literally weeks after we started quantitative tightening. I'm saying, the quantitative tightening is having an impact on the economy and small businesses and consumers in so many ways, but there's still a lag effect. But what I'm pointing out, you guys, is we've been from the point of first inversion, it's been 26 months. We've been inverted so long, it's kind of hard to fathom. But again, this is what we can look at if we don't want to listen to the bulls or the bears, and we just want to look at the historical precedent of caution. Again, this is forecasting, and this is a very reliable forecast, what is on your screen. So we don't have to listen to CNBC. We don't have to listen to Fox. We don't have to listen to Dave Ramsey. We just have to pay attention to the historical trends. What we're looking at now is the M2. This is the money supply. Now, I'm bringing this up because this is predicting a depression. not even a recession. And this is why I say that the last time, and this is not adjusted for inflation, this is nominal decline. That's an even bigger deal. But the last time that we've had a decline in the M2 money supply was during the Great Depression. So again, we have factors right now that are happening in our economy that we haven't experienced in almost 100 years. And still, people just don't care. The reason people don't care is people want to spend to the end. But I do want to point out recently, and this is probably why interest rates may even go up higher, is as of around February, the M2 has been noticeably going up. All right. So it has been going up. But nevertheless, what I'm talking about, y'all, is I'm talking about how unstable the economy is. Healthy economies don't lose M2. It hasn't happened in 100 years. Healthy economies function on their own. And what I'm trying to explain to you is there's so many things propping up the economy right now. That's why we see so many mainstream media headlines saying that everything's okay and that you should continue to spend because the labor market's great. Prices are only going to go up. We're out of the hard times. The doomers are crazy. That's all you hear. Type into Google, what are healthy things in the economy? And then look for those things and you'll see for yourself. This is the most unhealthy economy in my lifetime. And I went through the great financial crisis. I lost everything out of foreclosure, repo, bankruptcy. But this is why I'm saying right now is more unhealthy than the GFC. This is our smoking gun. Healthy economies can be profitable without government intervention. Healthy economies make the US money. The government does not have to be involved. Now, what I'm showing you right here, you guys, this is 2008. So from 2008 till about 2013, you guys can see the deficit right here. So fast forward to today, basically, here's the deficit, you guys. This is 2020, 2021. It goes down 2022. Somehow the deficit goes up in 2023. I thought we didn't have a recession in 2023. Remember when they changed the definition of recession in 2022? Well, they didn't stop spending trillions of dollars of deficit. This is a major issue. In fact, the crazy thing here is, because I don't want anyone to get political, the last time we had a surplus was 2001. How depressing is that? It's almost like people they just don't care. People do not care. And what I know is, and I think you guys should know this too, without that lifeline, without that deficit spending, we would probably be in some type of depressionary situation right now. We would surely have deflation. The Bank Term Funding Program that was opened back in March of 2023 really kicked the can down the road. Again, you don't have to listen to me. Just check the data. Let AI, we got so much AI now. Literally, go to your AI chat GPT or whatever and say, what are the factors that make an economy healthy? Seriously, check for yourself, you guys. I don't want you to keep your head in the sand. I kept my head in the sand during the great financial crisis and I lost everything. And all I had to do was change my life and improve my spending habits 6 months before I lost everything. And my entire life would be different. And let me remind you, it took me 9 years to crawl up out the gutter. 9 years. You know how bad it is down there? I couldn't get credit cards. I had to pay way more for everything. I had to beg to get a car. It was just a horrible place to be. And during my demise, the rich just got richer. I want you guys to win during the downtime. We can make a killing during a recession, but we must prepare right now. If you want to wait till we have a recession and then prepare, I'm telling you, usually that's not a good idea. You got to plan ahead to get ahead. And this is not a political hit job. I don't care who's president. The fact that job growth numbers are subsidized by a record number of government jobs is insane to me. Why are people not ringing the alarm? 25% of new jobs, guys, are government. Again, that is another sign of an unhealthy economy. So I've showed you guys the yield curve inversion. They're doing a bond buyback program. M2 money supply has gone down. Deficit spending is like we're in depression. Government jobs, 25%. Are you serious? That's not fair to the taxpayer, and that's not fair to the small business owner. We're financing that. Taxpayers are financing that. In 2023, the U.S. job market experienced a trend where nearly 25% of all job gains were attributed to government positions, underscoring a significant reliance on public sector employment to sustain economic growth. The development is particularly striking given the broader context of a thriving economy. So the person that wrote this is at least acknowledging, wait a minute, that's actually not, I repeat, that's actually not a thriving economy. They just have lifelines connected to it, marked by impressive job additions and the robust performance of the tech sector. Despite these broader economic successes, the surge in government jobs reveals a nuanced landscape of employment, raising questions about the sustainability and quality of job growth. And if we were to avoid a recession, we need to be making more money as consumers. The fact that adjusted for inflation, we're making less money. Meanwhile, the asset prices and just the cost to live skyrocketed across the board is horrible. In fact, you guys, we've never been in this situation before. A lot of people compare what we went through during the 80s to right now, but that they're only taking one thing: payment. What about the prices? What about the delinquency rate? What about the savings rate? What about the credit card debt? What about all of those things? You guys, the housing market right now is so unaffordable. We would need interest rates to go down to under 3.5% and or a 49% rise in median income. I'll take a 50% raise. That sounds good to me. And or a 33% decline in home prices, or a combination of all three of those things. Most people will agree that we're not going to have rates under 4%. So we can pretty much take that off of the equation. However, we're probably going to have rates go down. So we will have a little bit of cushion in the interest rates, which leaves prices and incomes. And the fact that real median income, household and family and personal has all gone down, it's really highly probable to consider the fact that more than likely prices are going to go down. Because again, if interest rates go down, then prices will just go up and it will wash itself. And then we'll be in a situation where we can't even lower interest rates. At least right now, the Fed has an option and ability to lower interest rates. But if they do that too soon, that ability is gone. Now, it's especially important to take into consideration the prices of houses. Now, what we have going on right now is extremely similar to the GFC because you have a PE ratio run-up, massive PE ratio run-up, really accelerating past the great financial crisis. You guys see that right here. We have a price problem. I've been trying to explain to that. Now, when the bulls compare the 70s and 80s, understand that when they're doing that, the PE ratio was in the 3s and 4s. I mean, how could you compare the 70s and 80s when the PE ratio was in the 3 and 4% and the savings rate, the US household savings rate, was 3 times higher? At least 3 times higher. I mean, this is incredible. But I'm showing you guys this because through this recession, not all recessions are the same, but through this recession, in my opinion, it's extremely likely that we will have deflation in asset prices. That's why I'm showing you this. Again, they don't want us to compare the GFC, but when we compare the PE ratio, I think it's a great comparison. Would you guys agree with that? Some bulls say that the GFC happened because we had hyper supply, too much inventory. But when we look at the 1990s, it's actually, we didn't have too much inventory. In fact, inventory shot up after we were in recession. And if you guys really want to look at the inventory, go back to right before we entered 1990. In 1989, in December, we only had 1.8 million active units. Think about what I'm saying, you guys. Real home prices peaked in 1989. The recession hit in 1990. Home prices fell 7% from peak until the end of 1990. The recession ended in the spring of 1991, but real U.S. home prices continued to fade for years until they bottomed out all the way in 1997, down 14% from the 1989 peak 8 years earlier. What's also interesting about the 1990s compared to what happened right now is how divided the housing market is. Just like, again, right now, unlike the 2006 bubble, which hit most of the country, the 1990 bubble was really only a bubble in a few major metro areas. For example, Boston, New York, Los Angeles, San Diego, San Francisco, and Washington, D.C. I think it's interesting because right now we have an everything bubble everywhere. Now, this graph is really cool. If we adjust the Case-Shiller numbers for inflation, the real size of the 1990 bubble for those cities is easier to see. So here's the run up right here, and here's the decline. So please, if anyone's watching this that also is a fan of Dave Ramsey, please email this to him. Because again, remember, he said we've only had one price decline on a nationwide average in 2008. That guy is out of his freaking mind. How can you say that? Because it's wrong. It's a lie. The guy has how many people work for him? 300 people? And no one gets this? You guys, 1990 had a pretty decent decline. Again, I think something similar is going to happen right now. We don't need massive amounts of stockpiling and inventory, even though we have it with new homes. But take a look at real prices. Boston didn't get back to the 1987 peak until the year of 2000. That's 13 years. So here's the thing, you guys. If you buy right now, have an expectation to hold for over 10 years. Okay, that's very scary because that's not holding. That's being in prison. That's being trapped for 10 years. Holding is like maybe for a few months or whatever, right? But for 10 years, are you kidding me? How could you possibly know what's going to happen in your life 10 years from now? Now, New York didn't get back to its 1987 peak until the year of 2002. 15 years. Los Angeles didn't get back to its peak until 13 years after. San Diego, 10 years. San Francisco, 9 years. Now, again, we're talking about the 1990 recession where we actually did have home prices, okay? Few observations of this article. Number one, home prices can boom and bust even without a boom and bust in subprime, interest-only loans, no doc, and negative amortization loans. Remember, all these people like, oh, the home prices crashed, and certainly it was inflamed by this. I would agree with that it helped it crash, but that doesn't need to exist for home prices to go down. In 1990, we didn't have all that craziness going on, and home prices still went down. Now, number two, once started, and here's the domino effect. It's like unemployment. It's almost uncontrollable. Once started, home price declines seem to become self-reinforcing and can continue on for quite a few years. So what's the rush? As long as you're on the sideline right now, increasing your purchasing power, you're doing everything right, you guys. I'm serious. Number three, as metropolitan real estate markets have become more synchronized, booms and busts may have become, sit down, everyone, larger, not unexistent. So people are like, nah, they just don't exist anymore. No, they can become larger. Number four, California seems to be particularly prone to unstable housing prices. Very interesting stuff here, guys. Let me just read this last part of suggestions. In conclusion, a correction of home prices is likely at some point, and the next recession could trigger like the 1990 recession was to some degree. First-time home buyers might want to make sure they're buying at least a 10-year home, a home that is likely to suit their needs for at least the next 10 years in case real home prices fall. All of this data, all of this presentation for you, just to tell you, I hope you win. And I hope I win. And the first step is being aware of a problem. We can't do anything if we're not aware of the problem, but understand that's just one step. Step two, maybe the bigger step, taking action. What action, and I want to challenge you guys, and I want you to comment below, what actions have you guys been taking the last 2 years? I've been reporting this stuff for 2 years and 2 months. What actions have you guys been taking to get ahead of this and to become a winner through the recession? I'll tell you what I've been doing. I've been trying to maintain and increase my purchasing power, my income, my assets, and my credit. And plus, I've taken all liquid cash that I can find and I've put it in things like T-bills so that I get money. I've changed the way that I use my money to buy things. I no longer use cash. I use credit cards that have high cash back percentages, and then I just pay the whole credit card off. So I'm doing everything I can right now, but the biggest thing that I need to do right now is be patient. And patience, you guys, is hard, but it is a virtue. No, other than that, guys, if you're out there investing in real estate, you guys already know that I wish you luck. I'm really excited to hear your thoughts on what I covered today. Please share your thoughts. Do you think we're going to have something similar happen as the 1990s, which was only a short recession, but it had long-lasting impacts in the housing market? Very interested to hear what you think. And regardless, you guys, I hope you win.